Disclaimer. This content is for educational purposes only and does not constitute financial advice. Always conduct your own research before making investment decisions. How to analyze a stock like a pro beginner's guide to stock analysis. How do successful investors decide which stocks to buy? Is it luck? Do they simply follow the latest headlines? Or is there a method behind every investment decision? The truth is that professional investors don't buy stocks based on hype, they analyze businesses. In this video, you'll learn how to analyze a stock step by step, understand the key financial metrics that matter, and avoid common mistakes that many beginner investors make. Let's get started. Step 1. Understand the business. Before looking at any numbers, ask yourself one simple question. How does this company make money? If you don't understand the business model, it's difficult to evaluate whether the company has long-term potential. Look at: what products or services does the company sell? Who are its customers? Does it have a competitive advantage? Is the industry growing? Who are its biggest competitors? Investing becomes much easier when you understand the business behind the stock. Step 2. Look at revenue growth. Revenue tells you how much money the company generates from its operations. Consistent revenue growth often indicates that demand for the company's products or services is increasing. While one exceptional year can happen, investors generally look for businesses that have demonstrated steady growth over several years. Growing revenue alone isn't enough, but it's an important starting point. Step 3. Check profitability. Generating revenue is important, but profitability shows whether a company is turning those sales into earnings. Look at metrics such as net income, operating margin, profit margin. A company that consistently generates profits is often in a stronger financial position than one that relies on future expectations alone. Step 4. Evaluate the balance sheet. A healthy company should also have a strong financial foundation. Review: cash and cash equivalents, total debt, current assets, current liabilities. Companies with manageable debt and solid cash reserves are often better equipped to navigate economic uncertainty. Step 5. Analyze free cash flow. Many experienced investors consider free cash flow one of the most important financial metrics. Free cash flow represents the cash a company generates after covering its operating expenses and capital investments. Positive and growing free cash flow gives businesses more flexibility to invest, pay dividends, reduce debt, or buy back shares. Step 6. Look at valuation. Even great companies can become poor investments if purchased at unrealistic prices. That's why valuation matters. Common valuation metrics include price-to-earnings ratio, P/E, price-to-sales ratio, P/S, price-to-book ratio, P/B, PEG ratio, enterprise value to EBITDA, EV/EBITDA. These ratios should always be compared with similar companies in the same industry rather than viewed in isolation. Step 7. Consider competitive advantages. One of the most important questions every investor should ask is: what prevents competitors from taking this company's market share? Strong businesses often have durable competitive advantages, sometimes called an economic moat. Examples include well-known brands, proprietary technology, strong customer loyalty, high switching costs, network effects, cost advantages. Companies with sustainable competitive advantages are often better positioned for long-term success. Common mistakes beginners make. Many investors focus only on stock prices. A lower share price doesn't necessarily mean a company is cheap. Likewise, a higher share price doesn't automatically make a stock expensive. Other common mistakes include buying based on social media hype, ignoring financial statements, chasing recent price movements, failing to diversify, investing without understanding the business. Remember, you're investing in a company, not simply buying a ticker symbol. Final thoughts. Analyzing a stock doesn't have to be complicated. Start by understanding the business. Review its revenue, profitability, debt levels, cash flow, and valuation. Then ask yourself whether the company has a durable competitive advantage and whether it fits your long-term investment strategy. Successful investing isn't about predicting tomorrow's stock price. It's about identifying strong businesses and allowing time to work in your favor. If you found this video helpful, don't forget to like, subscribe, and share it with someone who's learning how to invest.